Good morning, everybody, and welcome. This is the Saturday morning Viper Trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you are absolutely in the right place. Today's topic is setting targets and stops. This is part two of a two-part series. The first part was on last Thursday night. That is posted. It's up there in the subscriber area, so be sure to check it out. Prior to the webinar opening here, we took a poll of the team. We have several other topics that have emerged, specifically boxing in trades and band-aids and swing levels. So we are going to cover those topics here this morning as well. First, we have to get our standard disclaimer out of the way. So let's go ahead and knock that out. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. Okay, good. Now that that is out of the way, let's get over to screen one. And let's jump right in with this whole topic. There was several questions in relation to what we have. A lot of people. First of all, let me back up. If you're here visiting, welcome. If you're on a trial, welcome. I see a bunch of fresh new names and faces in here we haven't seen before, so if you're just checking us out, let me start with the very basics so we're all up to speed. What you're seeing here is one of the instruments that we trade in the live trading room, which is NQ. This is the NASDAQ futures. It's $5 a tick. Some other ones we'll look at today that are also in the trading room are YM. The Russell TF, by the way, YM is the mini Dow futures, also $5 a tick. The Russell, we may or may not get to the Russell, we'll see. That's $10 a tick. By the way, there's an extra data fee charge for that if you want to trade it. Some people continue to trade it, other people dropped it and don't pay the $117 a month for the data. And then, of course, everybody knows we trade crude oil. Gary kicks off every morning at 6 a.m. Pacific with trading crude, and we'll look at a crude chart in a little bit. So what you have here is you have a 4-range chart. This is what we've traded for years and years. And you see the Viper indicators, which include the background colors, the bar colors, the swing levels, denoted by the swing identification, the bands, the mid band, which is the thick line in the middle, 1, 2, 3, 4 bands above, 1, 2, 3, 4 bands below. Excuse me. We also have this notion of what's called the predictor. It's toggled on with this button like such. It also shows swing levels, but prints the ovals out ahead of time. So as markets are starting to move up and down, these ovals are printing, and a lot of people find them good for targets. Sometimes they're good for stops. It gives you a sense if they're sideways, clearly shows you're in a range. But the nice thing, you can toggle them on and then toggle them right back off, just like that. Generally speaking, around the opens in the first hour of trading, we need to be flexible in our ability to take longs and shorts. But generally speaking, if the background is sort of a lighter shade like this, you're usually in a trading range that might look something like this. We'll talk about ranges in a few minutes. And then usually when markets come out of ranges, they either go up or down. Generally speaking, if you have a green background with predominantly blue bars and the bands are stair-stepping upward, you're said to have an uptrend. So you're typically looking for long bounces to enter long. That's okay, Diane. We're just getting started. I know some folks are still coming in. Don't worry about it. We're still kicking things off here. You haven't missed too much of anything. Conversely, when the market starts to drop and you go into what we call a downtrending move, the look would be like this on the right. You would have a red background. You would have predominantly red bars. You can see here that the other things you can notice is the mid-band, and all the bands are stair-stepping down like this, in which case we are looking to trade sell short. We are selling the market in a downtrend, and we are buying the market on retraces in an uptrend. So very straightforward. Now, we had this question of the two primary questions that came in from the team here this morning before we got started with the webinar was this notion of a Band-Aid. What is a Band-Aid, and how do you trade it? And the second one was, what is this notion of boxing in? When you say the term boxing in the room, what does that mean, and what are we actually doing? Hold on one second, please. Okay, let's start with Band-Aid. So here's what a Band-Aid is. Okay, here's what a Band-Aid is. It's the simplest thing. And when you first hear Band-Aid, it may be like, what did I cut my hand and I need to put some Neosporin on it or something? No. All right, let's do this. I'm going to blow up 630, and let's really get detailed about this, because I know this is really an interesting topic for everybody. I'm here in California, so all these times are Pacific times. The open of the market is 6:30 Pacific right here. I'll put a thick band right here so everybody can see it. Okay, that's the open of the market right there. Now, going into the open of the market, is this market trending right now, yes or no? Here's the open, 6:30 Pacific. And I think this was Friday. This might have been Thursday. I'm not exactly sure, but this is the open right here. At the open on this particular day, was the NASDAQ market trending, yes or no? And if your answer is yes, what is the direction of the trend? Trending at the open right here. Are we in a trend right here at the open? Yes or no? And if your answer is yes, what is the direction of the trend? Are we trending at the open on this particular day? Yes or no? What say you, team? Let me put all that data back on here that you had just a minute ago. Okay, here's the pre-market session. Midnight Pacific is over here, so this is the European session for the futures markets. Here is pre-market. I think we had some news this particular day, so you had some news over here. And then here's the open right here. Are we trending? Yes or no? And if your answer is yes, what direction? Okay, interesting. We've got a mix. We have quite a few yeses in the downtrend. We have a handful of no's. And no major trend. Shorting, says Richard. So it's a real mix. Predominantly yes and downtrend and shorting, sprinkle with some no's and what have you. We are trending down. So the answer was yes, we are in a trend, and the trend is down at the open. Now, why do we say that? Okay, let's do this. Let's go back over here so that we're all clear on what to do when the market opens. Because I think this is a source of a lot of confusion from some traders is you'll get your charts all set up and you'll go in the room and then you'll look at this, you'll look at your charts, you'll look at our Gary's charts in the room, and there may be a sense of confusion as to what to do at the open. Is that fair to say? Some of you might feel a sense of a little bit of a confusion at the open, like you don't know what you're going to do next to trade. I'm seeing a lot of yeses. Okay, all right, well, let's talk about this here. Now, when you analyze the pre-market, it's very easy to do. Okay, it's very easy to do. You simply take some lines and you just go ahead and you put them right on your chart. Let's do a couple of lines together. I'd say in the pre-market, when you came out of this trading range to the left, you could put a line here at support of that trading range, yes? And by the way, what is the first thing we do when we come in and get ready to trade in the morning? What's the number one first thing to do? I'm going to go ahead and draw them while you're thinking about it, because I start almost every webinar where I do training, I start off with that question. What's the number one thing we got to do every morning with our charts? Draw the lines. Good. Just what I did right there. Did you see how easy that was? And how long did that take? 5 or 10 seconds? And I'm telling you, if you want to do one thing in the morning to prepare for trading that will help you orient yourself and give yourself a little bit of structure to trade around, it would be putting these lines on your charts. If you just get in that one routine, I'm telling you, it's going to make a huge difference, especially at the open, if you feel that sense or state of confusion that you just don't know what you're going to do and you feel like you're reacting. So please, please, please put lines on your charts first thing in the morning, okay? Nasir says, are the lines interfering with OT? So be careful. Well, I haven't experienced that, Nasir. If you have an issue there, get a hold of Gary. Maybe have to troubleshoot something. But I put lines all the time, and OT should work just fine, independent of the lines. All right, now let's talk about the open. So right before the open here, we can see that these bars, just visually on the chart, we can see that these bars right here took the support level out to the downside, yes? This is about between 6 and 6:15, so you're about 15 minutes ahead of the open. We had a break of this support level, yes? Notice how that break turned the background red. And you can further make note of the fact, and this is all visual things that you can just see right on the chart here, what happened to our bands and our mid-band. They begin to stair-step down, yes? Now notice what's happening right here. Now's where I'm going to blow it up. First of all, I want to make sure we're all on the same page. The trend is down. We are looking for shorts. Okay, at the open of the market, the trend is down and we are looking for shorts. Now, what types of trades do we take when we take shorts? What type of price action has to happen in order for us to sell the market? We're always very specific about that. That's something that we talk about every day. What type of price action has to happen? What needs to happen for us to short it? Retracements. Good. So let's be clear, because we do have a lot of visitors and we have new people. So I'm just going to be very, very clear about this. There are generally two main types, three really, of price action. When we say price action, that's just a fancy word for how the prices are moving. Okay, that's basically all that is, right? We have what's called the thrust, which is the markets are pushing in a certain direction. That's called the thrust. When the thrust, the pushing part of the move is done, you get what's called a swing. So the market stops for that particular point in time and it reverses back the other direction. That's called a swing, and it's marked by these little dots right here, okay? Swing levels, that's what the swings are. Now you can put lightning on here. Several of you pointed out you like lightning. That's another indicator we have. Gary uses it quite frequently. He showed it in the room. I don't have it on here. Lightning is just connects the swings with lines. That's what lightning is. And there's different levels of lightning you can use. After a market, generally speaking, has thrusted in a given direction, in this case down, you get what's called a retracement, where the market then pulls back up in the case of a downtrend. Now, a question for the team here. Why does the market retrace back up in a downtrend? What's happening? Here the market is pushing down, and now it's going back up. Why is it doing that? Here it pushes down, here it goes back up. We know why it goes down. Excuse me. We know why, because they're selling. All the algorithms and the computer programs from big banks and everyone, all the discretionary traders are selling the market. And when all the traders work together, market goes down because of the selling. That's right. Good, good. When all the folks who had short, you can have folks from way over here, even way up higher levels that are short. When there is profit taking on a short selling market, that's called profit taking. You cover your short, you buy to cover. So if you were short from an upper level and the market has gone in your favor and you want to buy to cover your short, you are in effect taking profits on your sale, yes? That profit taking or short covering in the case of sales, it has a natural upward tendency to push the market up. Now, in the room, Gary has the program set to paint a Band-Aid at 6:31 and 6:32 Pacific time. 8:31 and 8:32 his time. He's central, he's in Oklahoma. So we go on to our chart at 6:31, and we're going to do like this, because there was a lot of confusion this morning about what is a Band-Aid and how to trade it. So let's talk about that right now. Before we talk about the concept of what a Band-Aid is and how to trade it, first we have to understand what the term Band-Aid means. So each one of these is a band. Here's band 1. You see it? I'm not going to do all of them, right? You get the idea. Here's band 2. Right? You see the bands. So the middle line is in effect called the mid band, and then you have the bands above and 4 below, and they're color shaded differently. That is called a band. Now, at a given specific point in time, when you select a point in time, say 6:31, what will happen is a Band-Aid, quote unquote, a Band-Aid will paint in the band where the price is located at that time. So what that means, let's be clear, let's really blow this up so there's no confusion come Monday morning in the live room as to what a Band-Aid is and what it's doing. There's 6:31. Where is the price located at 6:31 Pacific? Where is the price located at 6:31 Pacific? Right here. See it? There it is. It's right there. So yeah, good. It's right there. So what will happen is the Viper script will paint a quote unquote Band-Aid right there. That's all it is. That's really literally all it is. That's all it is wherever the price is located at that specific point in time, it will paint a Band-Aid. It will paint that band, and we coined that phrase, Band-Aid. That's all it is. Now at 6:32, it is set to paint another Band-Aid, which is another way of just saying what? It's going to paint. Now, depending on exactly when 6:31 and 6:32 occurred, it could have either painted it up here, or it could have painted it in the same location as the 6:31 Band-Aid. Sometimes that happens. They'll paint exactly in the same spot. Oops, screwed up. It probably painted here. I'm guessing it painted here because there's a bar right there. So there's an occasion where... So is there a trade out of any of these Band-Aids? Yes or no? Is there any trades here that we're looking for that you could have taken on this particular day from the Band-Aids? Keep in mind, what types of trades were we looking for? We just talked about that a second ago. Everybody answered that question. We know what the trend is. We know what types of trades we're looking for. And at 6:31 and 6:32, we get Band-Aids right here. Yeah, there's short trades here. It's a short trade. You come up, you hit a swing level just shy of the mid-band here at 13.25. The market rolls over and it comes back down through the bottom of the Band-Aid. So you are short on this bar right here. Now, you could have been in ahead of time because it's quite possible you could have boxed it up here, in which case you'd be short on probably one of these bars right here. So let's recap. The market trend is down. We are looking for shorts, and the way that we trade as Viper traders is we short sell retracements. We wait for the thrust, we look for the swing, we look for a retracement, we look for the bars to roll over, and we get short using our tools. In this case, it just so happened to correspond with the Band-Aids that painted at 6:31 and 6:32 happened to hit right about where the rollover occurred, getting us short. Now, in the room, you hear this a lot when we get in trades. Go ahead and take your scalper coin. What does that mean? Okay, we entered short. It dropped in our favor. Just hit your scalper targets. Take your scalper coin. Probably hear that 15 times every morning. What does that mean? Take scalper coin. What are we talking about? Is that like chopping some wood or something? What does scalper coin mean? Does that mean shave? Go shave your face? Take your profits. Take your profits. Now, some of you are, like I said, are completely new to this, and so I'm going to explain things a little bit more in detail than I normally would. Exit a portion of your position for a profit, Peter. That's exactly correct. Now, when you enter a trade position and you're looking for targets and stops to manage your trade, generally speaking, there is some kind of swing level that's located close to where your entry is. In this case, it'd be right here. You can see that with the thrust portion of our trade, where it moves in our favor, we come through that support level, depending on where you got filled, like such. Generally speaking, your scalper target is going to want to be in the neighborhood of about 6 ticks. In the case of ES, it's going to be smaller. ES is a slow mover and does not move that much. A big move for ES is like 8 to 10 ticks, then you get a retrace. So your scalper coin might be 2 or 3 ticks on ES, okay? The Russell might be longer. Russell gets big moves. Russell can get 20, 30, 40, 60 tick moves. So scalper on that might be 8 or 10 ticks. You're going to have to experiment with your instrument. In this case here, let's say you got filled around this 11 area, plus or minus a tick, depending on which bar you got filled on. So 6 ticks would be 10 and a quarter, right? From 11? No. Yeah, 4, 10. I'm sorry, 9 and 3/4. So down in here, down in this area down here. So when we say take scalper coin, what that physically means is that inside of your object trader program, for your first target, you should set it at where you want it to take off one of your, we like to, here, just back up. We like to try to have traders trade at least 2 contracts because that allows you to take advantage of what we call the scalper trade, where you capture part of your profits quickly. You set that up in Object Trader. The second thing that we set up in there, and we have videos that show you how to do this, you have what's called a break-even plus setting. So when the scalper move occurs, and you say you have an initial stop of 10 ticks, so that might put your initial stop right up in here. We want to come down to within 2 ticks of our entry. Here's your scalper coin, took the profit here. Object Trader takes your initial stop, brings it down to within 2 ticks of your entry, like such. It does that automatically. Then you have a runner. Okay, so with your runner, let me put another line here. So it's an OCO. So what happens is that the 2 stops that you initially had sitting up here, oops, wrong type of line. Stand by. I'll leave this initial stop up here. I'm just going to leave that there. That's where it was, okay? So it's 2 contracts, so there's 2 stops sitting up here, yes? So we pop down, we take out that first scalper target right here. So you're out, you exit. Object Trader exits 1 position, and it cancels the second stop and moves the final stop, so you have 1 contract left on, and it puts it right there, 2 ticks behind your entry. It automatically does all that for you once you enter the trade. Now let's suppose that your second target was a runner that you were looking for to go out 20 ticks. So, that might be sitting somewhere down here in the anticipation that maybe this thing really fell off the map. Now, inside of Object Trader, you can also put automatic management of your trailing stops. In other words, it'll go ahead and it'll move your stops as the market moves in your favor in whatever condition you set. It'll move it down, and it'll move it down, and it'll move it down, and then wherever it hits it, it will take it out. In this case here, if you were following this line or you were following stealth, see how the stealth line kind of follows the price? Usually that's a pretty good tight stop level. It probably got you on one of these bars right here for the second contract on the stop out. I don't know, somewhere in here probably. If it had a little looser, you know, maybe it got you down in here. Either way, you know, you would have stopped out of this trade. So when the second stop out is done, the trade is finished. So you had leg one look like this for the scalp trade, and leg two would have looked like this. Question coming in. Do you have the feature built in that automatically behind your entry? Gary says it doesn't use it. It depends on how you set it up, Peter. I use actual physical stops, and it really depends on the situation and the timing in the morning. Sometimes I'll manually move them around because I prefer to do that. It gives me a little more discretion on where to put them. So for instance, sometimes you might hear me make comments in the room, and even Gary, about, okay, tight stops would be here, loose stops would be there. So, you know, I may have multiple positions on, and I'll put some stops tighter. I'll take profits at swings. I'll say, okay, there's a target coming up here down there at 0.05 3/4. You know, peel some off there if you're in multiples. Tighten your stops to, you know, close above 0.8 3/4. So what we're doing is that when we see identified targets, if you have multiples on, multiples would be more than like 3 or 4, like, you know, 6, 8, 10, 15, or 20. You got multiples on. So when markets come down to swings, we take profits. We tighten stops. We leave some looser stops. I might leave some stops way up here like this, and put some stops down and peel. So it really depends on your approach. You know, I like to peel. I like to tighten stops. I need to have some loose stops for some runners to just let them run and run and run. Some people prefer to, if your personal trading style is you don't really like loose stops, you can't handle giving back, you're not comfortable, say, okay, I take 10, 12, 15 ticks back from me. You know, I don't care if it runs 100 ticks, I'll just get back in. Then you would be the trader who would take the scalper target here, would stop out on the tighter stop, and then look for re-entry up here near the midband. So you'd be reboxing it and getting short back in here. Then you're re-entering. See that? You're re-entering, and then you're getting short, and then you're tightening your stops, and the process repeats itself. See that? Does it again. Does it again. Does it again. There it is right there. There's another one right there. You see them, right? You're getting in, you're getting out. You're getting in, you're getting out. Now, let me talk about the advantages and disadvantage. The advantage of getting in and out is that you're not giving, as opposed to the loose stop approach. The loose stop is you leave some loose stops up here. Now, the loose stop risk is that at some point, you know, the market pops up above here, gets your stops, and now you're foraging around up in here to get back in, yes? Some people don't like that. You don't like getting in and out. If you don't mind getting in and out, you pay a little bit more in your commissions. However, each time you pop down here and you get out, you're locking down profits. Although the multiple position person like me is also doing the same thing. The only difference is that instead of getting back in and out, I'm leaving looser stops. I'm just peeling at support levels on the shorts just like you are. Eventually, I think this thing falls off the map. Okay, so, you know, if you had that 20, 30 ticks target sitting down there, eventually you hit it on your runner. Yeah, Peter, if you're going to, so here's Peter's question is, if you're just trading 2 or 3 contracts at a time, is it better to use the closer, tighter stops? Yes, absolutely. Let me be clear about that. That's exactly what I'm saying. Yes. Yes, if you're going with just a couple of contracts, you really want to get in and out. You know, if you have the multiples and you can afford to do the looser stops, you don't mind the swinging up and down, and you're peeling some down here anyway. You're booking your profits as it goes down there. And then the looser stop trader, now after a market falls like this, okay, now let me shift that approach. Let me talk about finishing it out with the multiple contracts. Is once a market drops precipitously, as it did here. Let's talk about the size and the magnitude of this drop here real quick. So when it fell, you know, technically it rolled over up here at 11 1/4. Say let's say, I don't know, 10. Let's have a round number, 10. Okay, it's rolling up off of 10. Between 10 and 11, you're getting rolls off the midband. You're scalping, you're scalping, you're scalping. Finally, we get a nice drop all the way down here to 94. 94 from 11 is how many ticks? 6 plus 11, 17. 17 times 4 is what, 70? Yeah. Now, so let me be clear about this with the loose stop trading. If it didn't already take your targets out, if you see a market falling precipitously like this, and you drag your targets out of the way, sometimes we'll say that, look, it's really dropping, get those targets out of the way. You want to capture as much move as you can. Now we take that loose stop and we crank it down. We crank it down tight like this. Or you could even go up in here, but or at the stealth. It would have got you on the stealth. Either way, crank the stops down tight. So what's happening as it's dropping is, OT can do this, but you can do it too. You're taking that target out of the way. You're taking the target out of the way, taking the target out of the way, and we're kind of boxing it as it drops, boxing as it drops, boxing as it drops, and then we get out right there. So you capture as much of this on the last leg of your trade here. You try to get as much of it as you can. So it just makes no sense to leave it after it's dropped 70 ticks to leave a loose stop up here and give 30 of it back. The stealth line is this sort of loose line in the middle here. This is an old legacy. We used to use it more for trading. Generally speaking, it shows up in the short side when markets start dropping. It's an old indicator we had before we had some of these other ones. For a while there, we had the bar colors, background, and stealth. So it's an old legacy indicator. We just keep on here. You can use it for trailing stops. Some people do. Some people, let me talk about different trailing stop approaches. The tighter approach to stops, as you know, is to use this line right here and or a combination of that line and the stealth line. So I'm saying this line right here and the stealth line. Or you can go a little bit, the looser approach is between the stealth line and this line and the midband. That's the looser approach. So you might hear my numbers. My numbers sometimes will fall in between those with the looser stops. So that case it would be up here, up near the midband, in between the stealth and the midband. The tighter stops would be down here on that line right there. Or you could even follow the swings of bars. You could follow as the swing bars and it closes up, you get out. Let me just circle the different approaches real quick here on your trailing stop. So the tight one is the close of the bar above the previous bar. That's super tight. Second one would be the line right here. That's the next sort of loosest one, but still fairly tight in relation to retracements. The third most loose would be the stealth line. And the super loose ones that we call out in the room are up between the midband and the stealth line, way up here. Sometimes they're at the midband or even above if you want to go really loose. But let's talk about that for a second. So you know, here again, the advantage of it is that you're not of those super loose stops, and in a long protrended trending move is that you're not getting in and out. You're not getting in and out. You're allowing the market to move freely about as it makes its move. That's the notion of the looser stop. You're letting it wiggle around. It's going up and down, and you don't care because you're booking some profit as it drops at the swing levels, yes? Now let's see where the looser stop actually gets taken out. By the way, you did have a rollover here for those of you who did stop out, and you had a secondary chance for entry on the rollover right up in here. You could have used your line tool, you could have used the ray tool in Object Trader, or you could have used a box up in there. So we're continuing to box. Here's your line tool, your ray tool. It'll look very similar. Either by hook or by crook, you're short again right here for the last leg of this down move. Does everybody see that? So you have the loose stop approach where you leave it loose and the market's wiggling around and you're just letting it do its thing. In which case, you know, for the loose stop guy, trader, you know, you bounced from 94 all the way back up to 98. That's 4 times 4 is 16. So you have to be, you know, as I said earlier, if you're not comfortable giving back 16 ticks on your trade, in the belief that it's going to roll and give you another leg down, well, then you would simply stop out at the tighter stops and then look for reentry on a rollover in the trend direction, which is down. So you catch that last leg of that trade. Everybody see that? Now, the loose stop trader unquestionably got taken out right here. That was the final leg. But in the meantime, was peeling profits all the way down here at targets and what have you, and tighter stops. So let's recap what happened from the open on this particular day. We had one trade here early at the Band-Aids that was short, leg 1, leg 2. This never happened. We had trade 2, scalper, stop out, maybe break even. And if you boxed it in here, you got another little scalper, so I'm not going to count that. Let's say trade 3 at the mid-band here, scalper, runner, trade 3. Trade 4, those of you with the tighter stops re-entered on a box or a line trade, short again on that bar right there. And depending on how tight or loose your stops were, is you got a scalper. When it popped through that support level right there is your scalper. And then the second leg probably got taken out something like this. So in my view, on this particular morning, from the Band-Aids at the open, you had 1, 2, 3, 4 short trades. Now you're coming up on 7 o'clock. You're getting a deep retrace up right around the mid-band here. And let's just do some quick math. I'm going to do some quick rough math. Let's say each one of your scalps was what? 6 ticks, right? So you had 1, 2, 3, 4. 1, 2, 3, 4 scalps at 6 ticks. That's 24 ticks, right? And then these runners, maybe you got, I don't know, I'm just going to do this real quick. I'm going to say this one was maybe 10. This one was maybe 2, so there's 12. This runner was maybe, I don't know, 20, 25, so there's 40. And the last leg down here was 96 to 89, let's say another 20. I don't know, let's call it 60 on the runners. 84, 85 ticks times 5 is somewhere between $400 and $500. Okay, I'm just doing real rough math here. 4 trades, 8 legs, somewhere between $400 and $500. Now, at 7 o'clock here, you've been trading for about a half an hour. Say you were up a little bit before the pre-market session doing your lines and your analysis and what have you. You've been trading for 30, 40 minutes and you're up about $500. Should you continue to trade the market, yes or no? Market's dropped here. Well, from up here, it's like, looks like 80 ticks, maybe 90 ticks. And you got some good legs out of it here. Should you keep trading here? Are you at or near your goal? What say you, team? Four winners, 4 winning trades, scalpers and runners. What are you going to do? It depends on your goal. Yeah, I'm asking you personally. What would you do? I'm saying this was you. You took these trades, and we took them in the room, and you made that money. I'd venture to say a lot of you in here this morning would be very happy with 4 winning trades in a row in 30, 40 minutes, and you're up, say, around $500. It's probably time to stop and bank that coin. Keep trading. Yeah, time for golf. Load it up, risk it all on one risky trade. So this is what we're talking about, 1 or 2 and done. We want you to get into the market, see the good trade entries, pull the trigger and take them, bank the coin. Don't be afraid. You don't have to be scared of these markets. You don't have to feel unsure of what you're doing. You don't have to be intimidated about what the market is doing. That's what the tools do. We give you the form and the structure to see and take the trades. We're calling the trades. We're in the room taking these trades with you, physically taking the coin and the trades that you're seeing here. We're doing it with you. And so when you've made that money, you lock it down. You go into sim, go get breakfast, play some golf, whatever you like to do. Some people have part-time jobs, maybe family commitments. Because a lot of times, 9 times out of 10, after you get these nice moves like this, you get a lot of chop. Now let's see what happens here. Is there a trend change on this market? Yes or no? I'm looking at the right-hand side of the chart. I'll give you 10 seconds. Right-hand side of the chart. I'm over here right now. 8 seconds left. Is there a trend change on this market? Yes or no? Simple question. Wire it in. Just type in a wire it in. Time's almost up. 3 seconds. Trend change, yes or no? Simple question. Yes. How do we know? How do we know? Well, we can see that we had a retracement up into here, and we got some consolidation right at the midband, like such. Market consolidated right there, yes? And then it came up, and it hit the outermost band. Okay, this is usually where the line in the sand sits in relation to whether a market is going to continue up or down. Is a lot of times gauged by what it does when it gets up into here. Because at the time that that is occurring, we might still be thinking short, and we let it go a little further, and we let it go a little further, and hence we see that it never rolls over and never takes this out. So even if you box this in up here in anticipation of a short trade setup, you never got short because it never rolled. By the way, when you come in the room, you hear terms like, I'm expecting a bounce there or a roll up there. If it rolls over, I'm going to take a short. So let's talk about the term rolls over, I'm going to take a short. That means that when it comes up to a resistance level and the bars turn over and head down, that is the rolling over part of it. In other words, you have to have a bar roll over and break a swing or support or flip or come down. That's the rolling part of it. Breaks the box, breaks the swing to get short. In this case, we never got the short. It never rolled and broke. Everybody see that? In fact, quite differently, it went the other way. Now, in addition to the fact that that swing was broken to the upside, what other clues on the chart do we have to tell us that the trend is changing? Aside from the fact the swing was broken and we didn't get short, what other things are happening on the chart to the right-hand side of the rightmost part of the chart, right in here where I'm circling it, to tell us that are giving us clues that the trend is changing? What other things are happening there visually to help you see it? What else is going on there? Okay, we're getting some good answers coming in. Higher highs and higher lows, good. Breaking the swing, good, Endrajit, yes. There you go. Background and midband are colored green. Stair-stepping up on the bands, good, perfect. Background. So all these are visual clues. Okay, this is why we developed these indicators, was it's all a very visual thing for you to see what's going on. You see that the background is turning green. The bars are turning blue. The swing levels are being taken out to the upside. All the bands and the mid-band are all stair-stepping up. We have a green stealth line that's moving up underneath the prices. So the trend is no longer down. It's no longer sideways, and in fact, it is heading up. Now, with this move up here at 45.04, I think it's a good time to buy and get in myself right here. So I'd be hitting the market buy button because I don't want to miss the move because I know it's going to keep moving up. So I'm going to go ahead. I'm just going to skip OT. I'm going to go right into Object Trader and hit market buy and load the boat right up here. Anybody jumping in with me? Because that's what we do, right? Whenever a market moves up, we take longs. That was the rule, right? So I'm getting long right here. Market entry. I'm going to put 5 on it right there. Anybody in with me? I mean, that's how we trade trend moves, right? We get long. I don't know. It's a green background, blue bars, stair stepping up. You said the trend is long. It's time to buy, right? Market long right there. In fact, I hope I get filled on this bar right here. No, no way. I'm not getting in there with you. Don't buy thrust, says Nasirs. You will lose money. You've got to wait for the retracement. Minaj, good. I'll throw you a life jacket, says Walter. Good luck. All right, good. That was a quick little test. Yeah. Absolutely. Please, 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 a million times, please. Whatever you do, any market, any time of day or night, please, one thing to take away that's invaluable for your trading, do not, and this is a critical rule for our trading, right? Buy or sell thrust to enter. It's okay to take money profits on a thrust. That's what we're doing, right? So if you think about it, let's go back here for a second, where we shorted up here, or where any place where you shorted. We entered on retraces in the direction of the trend. The market comes down, it bounces back up, it hits resistance. We look for the retracement, we look for the rollover continuation move, down, we get in, and so what is this called? When it moves in our favor and we're short. That's the thrust, right? Here's another one, here's the thrust. What are good traders doing on thrust moves if you're already in from a higher level short? You're covering. You're taking your profits down here from the thrust. So that's one thing that might help you remember that, right? Good traders are always taking profits on the thrust moves in their favors. It's the traders who are getting stopped out who are getting in after the thrust move has happened at the apex of the thrust. So the traders who tend to get stopped out are selling down in here, and their stops are right here. So they're getting stopped out up here when what? When you're getting back in. You already booked your profits. You're selling to the trader who's getting in down here. The trader in here is getting in right when you're getting out. All right, so we don't do that. You know, if you were in the habit of doing that, if that used to happen, if you used to get stopped out all the time because you waited to be convinced that the move was happening, and when you finally got convinced it was actually the end of the move, and it just seemed like every trade you get in, and every time I get in, they know I'm in and they run my stops. Why do they keep doing it? Well, because you were getting in usually, well, I'm just saying, supposing some of you were getting in at the apex of the thrust, right as everybody's getting out. All right, so let me ask a question here. So everybody, not one person in here said that you wanted to get in on the thrust, which was perfect of this. Now, if this market, if it's going to retrace, where might it come to for us to look to get in? You said you wanted retraces. Everybody in here this morning said, do not buy this thrust. Wait for a retrace. Well, okay, well, we're waiting for the retrace. Where might it come? Where might it come to for us to get long? You said you wanted to buy it. Where might it come to? The peak of the move is 0450. Now, I've asked this question, I can't countless scores of times in other webinars. So those of you who are, and I know I'm not going to name names, but I see many, many of you come to almost all of our webinars. And so that's not a trick question. We have to, and we're not crystal ball people. You have 10 seconds. Where are you getting in the retracement? Where are you looking for? And I went into detail on Thursday night about this very topic. I usually go into very good detail. It's not like you're trying to predict the market or be some kind of future seer of what's going to happen, but we have to intelligently think about what we're going to do so that when the market does it, we're not in just some of this kind of reactionary mode. We're like, oh, I'm kind of expecting this to happen, and when it does, this is what I'm going to do. You know, think of it this way. It's a good way to prepare yourself for what might come to pass so that you're ready for it when it does. Does that make sense? That's what you want to do. You always got to be in a prepared state of mind. You got to get yourself ready for those markets to come right to you. Let the markets come to you. And then you know how to step in and what to do with it. Okay, we got some numbers coming in. Time's almost up. Where are you getting in a retrace here? Think about it. Indrajit, 4501. Nasir, I like Nasir's answer. I'll circle back to you, Nasir. I like that answer a lot. Okay, a lot of comments around the midband. Good. Box it in between. Peter put a range in. Good. Root. Okay. Wow. Okay. Walter, range. I love that. Good, good, good. Okay. Perfect. All right. So here's how I look at it. Here's how many traders look at it. It's not a number. Some of you put in a number, and that's okay. Some of you typed in mid-band, and that's okay. But we have to be prepared for the fact that the markets don't always come as deep as we want it to. Many of you put a range in that looks something like this. Many of the numbers were around 96, 97, all the way up to 02. With the mid-band being sort of almost kind of right in the middle. See the stealth line? See these lines? So here's a healthy way to think of it. When markets retrace, and it depends on the strength of the trend, they can either retrace in a very shallow manner, where they don't come very deep at all, okay? Which is just like the short covering on the sellers, only what's happening with the thrust move up in the case of the move up? It's profit taking to the upside that causes the markets to retrace because they're taking profits from all the folks who were long from lower levels or taking profits. That causes the retrace. And if the retrace is very shallow, we have to be ready for that. If there is more modest profit taking, it could push it down closer towards the mid-band or the stealth line. That's a medium amount of profit taking. And in some cases, there can be a dramatic amount of profit taking from a move and push it much deeper, even below the mid-band and the stealth line. Does everybody see that? So it's a healthy way to visualize it. When I look for retraces, this is how I look at it. Mentally in my mind, I am painting a box. In Thursday night's webinar, I use the analogy of a strike zone for a pitcher in baseball or softball. You know, between your shoulders and your knees. That's the sweet spot, the strike zone. We're looking for a market to come in here and do what? Bounce to get long. Shallow, middle, deep. So it's a range. It's not a number. Okay, Jack, I see that. Well, Chai, I'm trying. That's what I'm showing you here. So for practice, it's perfectly okay to draw an area like this after you have a big move up and you're trying to help visualize an area for yourself. Even if you're practicing in market replay or you're just looking at charts and sort of in your mind trying to visualize what might happen next to anticipate it. Let me give you some rough rule of thumb here on NASI. And it's different for instruments. Like the Russell's different, YM's different, crude oil is very different, obviously. So you have 04, 0450 is the apex. Now, if it came down into 02, 0250, what is that? 10, 12 ticks, right? Down near the mid-band, 99, 3/4. Say 00 off of 4, that's closer to 15 ticks. 15, 16 ticks off the 04 up here. You know, maybe even 18 ticks. So look at it this way. The move started up, I mean, you could say technically the move started up way down here at 92 or 94 to 04 is 10 times 4, which is 40 ticks. So you had roughly a 40 tick move here, plus or minus. Yes? What's half of 40? You could do these calculations in your head pretty quickly, by the way, if you look at them. 20. So where does 20 put you off of 0450? Yeah, right down around the midband, right there. So that's your modest retracement right here, right around the midband. Now deeper, probably, I'm just eyeballing it, 61%, if you use fib numbers, would put you at the bottom on the deeper retrace. So shallow, middle, deep. Everybody see that? That's how when we visualize the potential of a retracement where we might get in, that's how a healthy way to look at it. Then it says at 4,500 a bounce, I'm getting long 5 contracts. Okay, all right. Well, let's play this out. Let's see what happens. Okay, you're dropping. What's happening right here? I'm extending our range. What's happening right there? Okay, let me advance it a little bit more. What's happening right there, right now? What happened right here? What happened right there? Well, it's profit taking, yeah, but what did it do? What did it do right there? Here, let me give you a little more to work with here. It came into the top shallow end of our sweet spot. It didn't get to the mid-band. Well, it got to 4,500. You got your fill, Dennis. You see that? He said he was getting long 5 at 4,500. Well, you know, depending on where you put the order or how you placed your order, it bounced right off of 4,500. Some of the other traders who boxed it here, because it's the upper end of your opportunity zone, got long right here. So it never got to the mid-band. There was a handful of traders, and that's perfectly acceptable, who were anticipating that it was going to get lower into here, and it never did. So that's why I'm trying to show here. That's my illustration of what I want to close out. I'm going to wrap up now, running a little long in the tooth here, but think of it this way. Try to please, when you think of retracements, think it's healthy to think of them as an area, not a number. An area, not a number. You have to be prepared for shallow retracements in a strong trending move, mid-band or modest middle amount of profit taking, support bounce, and then of course we all know they can go much deeper below the mid-band and still bounce. All right, that's a wrap. That turned out to be a heck of a nice trade too, didn't it? Look at that thing, ran all the way up. Depending on your fill here, the thing is up, I don't know, to 40 ticks. There's a 40 tick runner right there. Definitely got your scalper, took that out and a lot more. That was a beautiful run. Jack, you might be thinking about Gary showing the object trader, and inside the object trader is the P&L for the day. Sometimes he flashes that up there towards the end of the session. That might be what you were thinking. No, I believe when he shows those, I believe that's his live trading account. Yeah, when he shows those numbers, that's real money. Yeah, that's not sim. We don't trade sim. The only time we trade sim is when we've hit our goal. But we trade, that's how we primarily make our living, is through trading. And we created Viper because we wanted to share the tools that we use to trade. Let me turn the recorder off. Thanks for coming, everybody. Stay cool. Merci beaucoup.